Good afternoon, everybody, and good morning if you're on the West Coast. We're going to start today and talk about Investments 201 as a follow-up on our series for the investment advisory team. Last month we did 201, and just to get us started, to brief about myself, I'm the Chief Investment Officer here at McQueen Financial Advisors. We have a good full staff of advisors with a little over 12, almost $13 billion in assets, full credit department and research team as well, overseeing all of our assets together as a team. Administration-wise, if you move your mouse on your screen, there'll be an option there for submitting Q&A and a chat option throughout the presentation. Please feel free just to throw a question out there. As we go through it, I'll be monitoring it and watching it a little bit. And then also today's webinar will be recorded and on the McQueen Financial Advisors YouTube channel, along with all of our other webinars, so you can share that with other people with your institution as well for those that are not able to make it. All right, so first thing I want to do is just, since this is 201, I want to just do a really brief, quick recap of our 101. Then we'll go into talking about portfolio diversification, the importance of it in managing a portfolio. Dive in a little deeper into asset classes. We did touch base on them in the 101. For 201, we're going to talk a little bit more in depth and details about them, and then get into portfolio duration and how the whole balance sheet needs to be taken into context when actually properly managing a portfolio. We'll sum it up with some key takeaways and then have some follow-up question and answers for ones that I didn't answer throughout the webinar or any that come up at the end. So without further ado, on 101, we covered the really foundation of managing a portfolio is the policy. The importance of it has to fall within the guidelines of the federal agencies, whether it's NCUA or FDIC, or if you're state insured. But that is the guideline for managing a portfolio and determining what you can and cannot do, and the do's and the do's and the don'ts. Talked about what is a bond, the components of it, the coupon, the maturity, and then we went into some basic portfolio structure, which we're going to get into more strategy today. And then went into asset class diversification conversation. And then we also talked about is trading, how it works, difference between new issue, secondary trading, and how the markets work and function, and then proper documentation for various asset classes. Extremely important for pre-purchase as well as post-purchase as well. So we only have an hour today, and I've got a lot of topics to cover. So I'm only going to briefly talk a little bit about what's the latest and greatest in the economy. It will literally be a couple minutes. And what I really found and liked was this history for Fed funds target. And it's in chronological order, the very top being last week. You can see that top line, June 15th, they raised Fed funds target rate by 75 basis points. Now, Fed funds is the target rate for overnight lending between institutions. And it was a shocker. And you can see the middle column, survey or actual, and you can see it says surprise. So the actual futures market expected a 50 basis point increase. Jerome Powell and crew decided to vote on a 10-to-1 to raise it 75. So it was a surprise tightening. It puts our new range to 150 to 175. And you can see how it works if you slide down to say the second from the bottom row, or actually the bottom row. Let's look there, March 3rd of 2020, pre-COVID, we were at a target rate of 1 to 1.25. So this is the highest we've been since March of 20 on a Fed funds target. And then the second from bottom row, you can see as a response to COVID, the economic turbulence that we were experiencing, they did an emergency drop of 100 basis points and went to 0 to 25. So fascinating stuff. They don't have to move in increments of 25, as just recently proved. That's a big question that we get, especially from people that haven't been in the markets for a long period of time. This is the actual futures market that I have on here. Very interesting to look at. The left-hand side gives the rest of the dates of the Fed meetings for this year. And then also I have in the bottom row the first meeting in 2023. And then you go to the far right-hand corner for essence of time is what is the futures market expect the overnight lending rate to be at any given point on these dates. So July next month, it looks to be a 231 is the expected rate. So if I go backwards, remember we're at a target rate of a 150 to a 175. So about a 50 basis point spread is what the implied rate right now. September a 293, another 75 above that. To raise 75, the actual effective rate where things trade is, somewhere around 62 basis points higher and so forth. But bottom line is the futures market expects Fed funds to be a little over 3.5 by the end of this year. So it's interesting to think about that. And I want to give this chart too, because the previous one was what the futures market is. Who's making financial bets on where the interest rates are going to be. This chart now is from the dot plot. And the dot plot is a periodic survey. It's not at all Fed meetings of where the actual members of the FOMC feel that where rates will be. And for them, by the end of 2022, they are only saying a 339. The markets on this page, 361. So the members are not expecting rates to go as high as the futures market for people that are making bets. 23, the end of 23 at 378. And then 24, the governors are expecting the on average for it to come back down. And then longer up, back down to a 243. So they're expecting an economic cycle. And I think that's the biggest debate that we are experiencing right now is we have a massive amount of inflation going on. PCE is showing it, and you can see this chart. I apologize for the black background. Operator error, could not change it. And but you can see we've been kind of mundane with respect to the PCE, personal consumption expenditure, right around that range of 1% to 2%. Had COVID hit, dropped down to a big negative, and then it's popped back up now at the end of 21 and 22 to where it's at really historic levels right now. So we are experiencing inflation. Gas is a great component to think about it. The other flip side here is sentiment. University of Michigan consumer sentiment now is really looking poor. You can look back for the last 10 years. Range bound has been 72 all the way up to a little over 100. Last report, it was at 50. So you think about where the Fed is raising interest rates, a lot of inflation when they're raising it to offset that inflation, but the confidence in the economy is not there for the consumers. And so we have two different dichotomies here working against each other. And I don't want to say the word, but stagflation comes to mind. A lot of people use it. A lot of people use it in context properly, and some use it not necessarily knowing. But ultimately, we do have high inflation. We do have a good economy and growth, but it's really slowing up. And that's where you get into stagflation is a slow growth economy with high inflation. It puts the Fed in a very difficult situation. Ultimately, we do expect rates to be continued to raise. I don't expect them to go up as much as the future markets do go up because we are starting to see some signs of slowdown. So now that's all I'm going to put on the economy because on the 29th, a week from today, we are going to do our semi-annual state of the economy. It's going to be a whole webinar dedicated to the economy and what's happening, what we're seeing, and what our expectations are. That's on the 29th. Don't miss it. Be there. So I just wanted to prefix it with just a little bit today. So now we're going to get into 201 investments. Portfolio diversification. It is the key. And one of the reasons that you want to diversify your portfolio, it's to avoid concentrations in any certain segment or asset class. Because as we all know, certain asset classes will shift in value, they'll also shift in credit risk. And we're going to talk a lot about our different asset classes, but those concentrations can get a financial institution in trouble if that asset class starts to suffer. And so you really want to have a good diversification amongst them so they work in unison, or at least complement each other, as one's maybe in disfavor, others are in favor. And you want to have that set up in your policy to be able to do that. In this, looking as you rotate through asset classes, depending on when you're deploying liquidity, you may want to be within the same week, where we might be looking at putting on a couple of different asset classes onto the balance sheet. It could be that we're looking at credit related stuff through corporates or municipals, and at the same time wanting to have that cash flow, that mortgage related products come through. So it really depends on where that value is at any given time when deploying liquidity, on how you need to do it. And then also not just deploying, but when you're shifting out of asset classes. So it's always good to look at, and I know the majority of our participants are buy and hold balance sheets, right? So, but you've got to make sure as you're managing your balance sheet is you don't necessarily always have to be a buy and hold. It could be that, hey, this is a disfavored sector. Yields are high. We're going in today, but 6 months from now, value shifts into another one. There really has been a strength in what we bought prior 6 months ago, and there's gains to be harvested and shifting into another asset class that's offering a lot higher yield. Therefore, harvesting gains, shifting into better yields. So, and then it's also managing risk, not only the credit risk from credit related products, but interest rate risk. So when you have various types of asset classes, it's easier to manage risk because you have a lot more options to look at. And then lastly is diversifying, is your different types of maturity diversification, building a ladder, putting in an average life that's appropriate for your balance sheet allows you to use all these different asset classes to diversify to create a average life that is appropriate for you. So how do you diversify? And there's 3 components to diversification. You've heard me say the word already many times: asset class, altogether, asset class. And we're going to go really deep into asset classes in a little bit. But on the right-hand side, you see the pie chart, and there's just a little high-level example of whether it's GSEs and agencies mixed with municipals, government guaranteed, whether it's CDs, treasuries, SBAs, and corporate bonds as well. That helps us diversify amongst asset classes. Term is also very important. You don't want to always have, depending the same maturity or all of your cash flow heavy in 1 year. You want to diversify across terms. One, what helps manage that duration of your portfolio, but also 2, you want to look at where that relative value is across the curve as the shape of the yield curve changes. And then lastly is timing of your purchases. Just like the old saying is you really want to, in the stock market, buy high, sell low, or is it buy low or sell high? Right? You want to basically look at deploying liquidity into your portfolio over time. If you actually do all of your transactions in 1 week or 1 day and rates significantly change over the next month, well, you're now all of a sudden locked in at those really low yields where rate yields could have been a little bit higher, or vice versa. The vice versa would be, hey, woo, we nailed it, but it is a deliberate bet on interest rates. So deploying your liquidity over a planned purchase plan over a period of time helps you dollar cost average into the market and not be at risk of buying at the wrong time. So that being said, let's go into some asset classes, talk a little bit about what they are, some really elementary ones. We're going to go by really quick. I'll spend a little bit more time on some that have a little bit more detail and sophistication to them, if you will. So first, and the most common type of asset class is the riskless asset class of treasuries. Issued by the US Treasury, they're zero risk weighted, they're guaranteed by the US government. It is explicitly guaranteed, there's no risk there from a credit perspective. There may be interest rate risk just depending on what type of treasury, what length of maturity you're buying. They are fixed coupons, they have a final stated maturity date. If you hold them to maturity, you're getting your principal back in addition to receiving all of your interest along the way. So they are what you call is a riskless investment, which a lot of markets do a spread in price off of a riskless curve, which is the treasuries. And you can see the curve right now on this chart. The green line here is where treasuries are. And it's interesting to look at that 3-year, and then you shift to the 5-year right in the middle and the 7-year, and it starts to go down. And that's not it's not an illusion. The shorter part or belly of the curve is higher than the 10-year. And even today, we had a rally in the treasury market today. The 10-year is below the 3, 5, and 7-year treasury yields right now. So, but this is treasuries. Now, next thing that's kind of common, we see it a lot when we bring on new portfolios, is a big use of CDs. A lot of line items, 250,000, multiply it out by 200 line items. But these are just CDs issued by financial institutions. By us, right? We take in money, we issue broker deposits. They can be done directly. You got to be careful with doing direct deposits. That's a future webinar. But these are very low risk. They're small. They're 20% risk weighted, which, you know, that's another conversation as well. If they are guaranteed by the NCUA or FDIC, I don't understand the risk weighting because it is government supported, but it is risk weighted. The rates are really based on needs of the sector. So as we know, we all are flush with liquidity over the last several years. And as depending on the outlook of what's happening on the economy, we might all of a sudden say, hey, now's the time. Rates are going up. Let's, issue some more certificates of deposits and we're locked in at low rates. And then all of a sudden we have a couple of economic hiccups, COVID hits, the war breaks out and rates drop like a rock. And all of a sudden no one needs liquidity because even more liquidity comes in. So that our industry cycle dictates more often than we really care to admit what that spread is as two treasuries. And the next chart is a good example. A couple of our portfolio managers put this together in November, was Kelsey and Alicia. And you can see this, a lot of lines here, very pretty, but ultimately what it does is it's showing you the CD issuance spread over treasuries. And where we're at last year was, it was pretty much on top of treasuries or actually lower than treasuries. So if you're raising liquidity, great, low rates. But if you're an investor deploying your liquidity into an investment portfolio, we wouldn't necessarily want to buy a CD that's lower than a treasury. CD is not pledgeable. We are only buying pieces of 250,000. What you really want to look at is all right, I got to look at treasuries or something else so I can maximize my portfolio yield for earnings. The next, we're going to get into the third most common asset class is agencies. So agencies and GSEs, quick definition, quick fact, agencies and GSEs are not synonymous. The whole brokerage world says they are, and you get marketed by individuals, but ultimately US agencies are entities that are formed by an act of Congress, whereas, but not owned by the Congress or by the government. GSEs are government-sponsored enterprises that are formed by acts of Congress, but not owned by them. So that ownership really makes a big difference. The biggest example of a GSE would be your Fannie Mae, your Freddie Mac, Federal Home Loan Bank, Federal Farm Credit Bank, Federal Agricultural Mortgage Corporation. Those are the top 5 GSEs, not agencies. Once again, they use the terms interchangeably. That's fine, but I just wanted to give a little, since this is 201 and not 101, I wanted to give you that little added information. The GSEs are implied guarantee from the Treasury, so they consider them riskless. During our economic meltdown, there's debate there whether they were, and ultimately it was decided they were. It's not necessarily now, it's implied guarantee. But what this story is with them is we're looking for an asset class that we can get absolutely increase our yield over a riskless treasury option. And agencies normally do that. Depending on cycle and part of the curve, it's not always that case. Now, you'll see that on the next chart when you'll see a yield curve. Structures of agency issuances can be have a big variety. Bullets are what we kind of are used to, like a CD. You buy today, you have a coupon, and it matures at a fixed date down in the future. That's what they call as a bullet, non-callable. They do have callable securities. Brokers love that community because by that issuance, because there's a little bit of underwriting spread that goes along with them. Not a problem. It might have a little bit of appropriate spot in somebody's portfolio, but you want to basically reduce or minimize the amount of callable securities, whether it's agencies or munis or corporates, that in your portfolio, keep them to a minimum when rates are high and and the reason being is they are negatively convexed. They can go away when rates do fall. And we all know rates, what goes up must come down, and interest rates constantly are going up and down. And so issuers that issue in our environment today will have that option to refinance that debt that you invested into when rates come back down. So it's negatively convexed, and you want to minimize that when rates are high. You want to lock in high rates. When rates go down, you just enjoy that extra yield, when others that bought the bonds with all that extra call option have to reinvest at lower rates. The call features can be varied. It can be callable in 1 month and then continuously through maturity. It could have a call in 1 year and only callable one time, or call quarterly. Lots of different options they can issue them with. And that's one of the arts of analyzing a callable bond when going into the marketplace. So another agency type bond, which is really hard, and in addition to being callable, is a step bond. It's another thing where if you drink the Kool-Aid, you might be saying, hey, this is awesome. I can buy a bond today. And if it doesn't get called away, the coupon will keep stepping up until maturity, and we get this great yield. Once again, you're selling optionality to the issuer, and you're at a disadvantage to somebody having that option. Because once again, if the overall market rates don't continue to go up, they're going to call that bond away. They're not going to let that coupon go up. So tough to model, tough to really understand what is my risk in this portfolio. So I really discourage that step bonds, minimize bonds that have the call feature in a higher rate environment. And then lastly on agencies is this is the spread of agencies. This is as of the 21st, or on the 17th, excuse me, of agencies over treasuries, and it's bullets. And you can see treasuries is the green curve, going to be the green curve always. And the fuchsia line on the short term, you can see its agencies were pretty much nicely spread over to where you get into that 2-year. It's a very popular sector for people where the treasuries are higher than the agency. So it doesn't make sense. You buy the treasury if you only have those two approved, to where they're pretty much the same until you get out to 6 years and farther. So, and these relationships change constantly throughout trading days, quite frankly. All right, we're going to get into municipal bonds, very relevant for all of us. And municipal bonds, just a high level, are issued by U.S. state and local municipalities. Examples are cities, our villages, our building authorities, and they can be issued in 2 formats. And we're going down now to source of funds, meaning I'm going to invest in the municipality. How are they going to pay me back? Where do they get their money to pay me back? And what do they pledge to me from their cash flows so I get paid back? The left-hand side is the general obligation. And that is where they use taxes on their footprint to levy and pay back debt issuances. And there's 2 types of GOs. There's limited tax and there is unlimited tax. So the the Cadillac, if you will, would be the unlimited tax GO. They don't need to go to voters when you have either midterm elections or a normal election year when, hey, our school district is coming to market, they're coming onto the ballot to get an approval for mills to increase our mills so we can pay for a project or something of that nature, limited tax. Where unlimited is they can raise taxes to whatever level they need to in order to make that debt service payment. So from an investor standpoint, it has that little extra security there for you. And when you're looking at a limited tax now, where they have to go back to voters to approve in order to increase the mills to cover debt, that's where you want to really dig down deeper when thinking about investing in that entity of where's their tax rates at now in mills, and what is the voted approve, and is there a lot of gap in there? On the right-hand side, now we're going away from tax-based sources to revenue-based sources. And that's where you can have a dedicated revenue stream from an issuer that is pledged to pay the bond off. Now there's a second bullet point in there. A couple of the things that should go in there are parking facility structures. Woo, stay away. Another one could be airport revenues or university bonds for either student housing or just general, all revenues collected by universities because they don't have the taxing authority. But the dedicated revenue stream, you really want to look at what is the debt service coverage ratios, what is their flexibility in increasing the fees, will there be market pushback for those increases. Then you can see the bottom bullet point for each of these, the risk weighting. There is different risks, and you can see the GOs are 20, the revenues are 50, and you're kind of getting closer and closer as you get to revenue towards like corporate type debt structures that are 100%. Okay, let's go on here and talk a little bit about what's appropriate for you from a municipal standpoint. And it really comes down to taxation. For banks, we have banks on this call, we have credit unions on this call. For banks, you can have both the advantage of having taxable bonds in your portfolio or tax-exempt bonds. And for credit unions, it really kind of makes sense to focus in on the taxable municipal sector. And basically what the difference is from the issuer standpoint is if they can issue a tax-exempt bond in the general market, tax-exempt bond is the largest sector that exists. Most issuances, the 200 million, the 500 million, the $750 million bond issuances are typically general market tax-exempt bonds. Not bank qualified, but tax-exempt. So that kind of takes away some of the advantages to us. Then they have bank qualified tax-exempt, and that's where the issuer they have to meet certain parameters. One is the limitation that they can issue each year of up to $10 million. They waived that for a certain period of time during the Great Recession. But there is an advantage because you get an additional discount or ability to deduct carrying costs for some of that. So that helps it become bank qualified or it causes the bank qualified to have a little bit of a benefit. And then in the taxable is interest earned on a taxable municipal bond is taxable to the investor. So just depends on what your tax situation and which one makes sense. Any three of these do not impact the security of the credit of them. This is strictly of what financially makes most sense for the investors. Then lastly on municipal bonds is credit risk. So we do have a future webinar. We're going to talk extensively about credit here at Investments 201. I'm just going to talk briefly is before entering into any credit-related investment in the municipal space is understanding the issuer and how to evaluate the source of funds and its risk of not being there or impairing their ability to make good on the investment that you are considering, and writing up a credit analysis on it, assigning your rating for that and saying, yeah, it fits within our policy requirements. There typically is no guarantee outside of the issuer or funding sources in municipal bonds, meaning there's not the US government guaranteeing this. There is secondary insurance they can buy and pay for. That's another conversation in our credit webinar of which doesn't always prove to be correct or reliable, of them buying an insurance company wrapper on top of their guarantee of paying the debt. And then lastly is on the value, is trying to evaluate where is the value. I mean, you could just look at a bond and say, well, this one has an extra spread over riskless investments of 30 basis points, so I'm just going to buy that one. Well, without doing the credit risk and understanding, well, that one with an extra 30 basis points is certainly it's certainly going to have a little extra credit risk, and making sure you understand that. We'll leave it at that, and we'll continue on here. I wanted to show you just a curve here because of our audience. Everybody can buy taxable municipal. I did a comparison of the riskless green treasury curve to a AA rated taxable municipal, and the fuchsia, and you can see in the short end, call it 9 months and shorter, you can see actually treasuries are higher, but then from 9 months out, it really has a little bit more spread to help you maximize earnings for your income statement. Okay, well, let's get into the next most popular type of credit-related investment, corporate bonds. So corporate debt, most of us can buy them unless you're a federally charter credit union. Then you got to really limit what you do into bank notes. But corporate bonds, we like to stick with U.S. corporations, U.S. domiciled. It's a little more transparent on their financials, and understand in some states you're actually mandated it has to be U.S. So we're just going to talk about them a little bit, but they're very similar from a credit standpoint and process as to municipal bonds. The benefit in the corporate bonds is the corporations are required to issue quarterly financials, and it's called 10Qs. There's a 10K, which is their annuals, and those are what you are looking at to evaluate the credit worthiness of the issuer. They're only backed by the full faith and credit of that corporation. There might be an insurance wrapper. It's very uncommon. It is possible, but very uncommon. And ultimately, when you're investing, you really want to be just investing in the issuer, not necessarily the insurance wrapper, because there has been times in history where people have relied too much on insurance, and all of a sudden, when they kind of went back and looked at the exposure, the concentration of their portfolio in certain asset class like corporates or municipals, and they said, whoa, wait a minute, we have a good variety of issuers in, say, municipal debt, but we relied on AMBAC for all of them, and all of a sudden they got too high of a concentration on this insurer or insurance company. So you got to be really careful there. Corporations, guaranteed by the corporation only. You got to really look to those financials and then monitor them, meaning not one and done on your credit analysis. We as institutions in this call are used to booking loans, and we want to take our corporate risk in our lending portfolios. If you have a lending portfolio where you do have to have where you can't have a high loan to asset ratio or loan to deposit ratio, and you got to have a larger investment portfolio, then you maybe want to put in corporate bonds because you don't have the opportunities to put in enough corporate risk, and that's where you're coming into here. But the one and done on those loans are a little different in the investment portfolio. You want to continuously do your credit work on an ongoing basis, annually with municipals, how they issue their financials, and quarterly for corporates, and update your credit every quarter. The reason you want to do that is just so if there is a trend that's starting to develop, the strength of their free cash flow is starting to deteriorate quarter by quarter, revenues going down quarter by quarter, whatever, their debt structure is changing and flipping, where they're issuing too much debt and their debt to equity ratios starting to trend up, right? Sign of a liquidity event that may happen for them down the road. You have the ability to sell that bond. Not that it's good, and you could sell out at a gain, quite frankly, prior to anything happening, but that's what's so important with your credit and how you do this, to pay attention to that. Okay, let me check the time and keep going. All right, then lastly, relative value. So Treasury, green line, riskless curve. The fuchsia line is the US corporate AA credit curve. And you can see the spread between the two does fluctuate over time. Short term has some nice short spread, gets a little tighter as you get closer to that 2 to 3 years part of the belly curve, and then widens as you go out farther. So there is value there. It takes a lot of work. You got to be careful. We will talk in the future in a future webinar about credit, and we can talk more about that. Now, some really fun stuff is the mortgage backs and CMOs. So residential mortgage-backed securities can be packaged through CMOs, can be packaged through MBS. Acronym RMBS is synonymous, residential mortgage-backed securities. And these are just loans that are backed with a pool of collateralized loans that are residential mortgages. Everything can be put through as a plain vanilla mortgage-backed security where principal and interest passes through the trustee or servicer, and whether it's Fannie Mae or Freddie Mac, they clip their guarantee fee and it goes into the investors. Then we can get into CMOs, and CMOs, they can be structured as a pass-through entity, but that's usually not the case. They actually have the structures that have different waterfalls for different tranches, which means you'll have a group of loans, call it 100 million worth of residential mortgages, and all of their payments flow into a trust. And then they take those trusts and they start paying tranches based on their priority, contractual priority of who gets paid first from an investor in what tranche. And that's where you can get really complicated in the CMO world. They're not a bad investment vehicle. They just can become complicated. It's important to understand them and understand that. And then also make sure when looking at MBS and CMO, those actual loans can have a variety of type of loan characteristics. There can be high loan to value loans. There could be low loan balances. There could be reverse mortgages, right? There could be so many different types. There could be a lack of geographic diversity in the loans, meaning they're all from 1 or 2 states. So really important to really look through and dig down into that loan pool. What are their characteristics? Lastly, these can be used for, and typically it's on the MBS side, you can have these specifically developed or pooled together for CRA purposes, meaning all of the loans are for low to moderate area or low to mod borrowers and are wrapped into a Fannie Mae pass-through, and you can invest and then get CRA credit for doing it. Because they're wrapped in, we're talking about agency wrapped right now, not private label. They are 20% risk weighted according to accounting standards. Okay. When looking at CMOs and MBS, there's just a few things that really will help you start to stay out of trouble. One really ultimately is prepayment risk. You look at the types of loans that are in there and what is their propensity to prepay, and what did you pay for that bond, and are you modeling it? So when you're looking at these, there is, if you're paying a big premium, meaning a price above 100, you got to really understand what your prepayment risks are and what your returns will be if they start to prepay. Ultimately, if you have those, you want to look at them and understand is there negative convexity to this bond? If you pay a premium and all of a sudden rates drop and you bought a structure that it's conducive for cash flows to come right back to you. If rates drop, you have negative convexity because your bond's going to get accelerated on your cash flows back to you, and you're going to get into really low to negative yields because of accelerated amortization of premium. Really understanding it, analyzing it. We do not recommend that type of convexity in this rate environment. Similar to callable bonds in this rate environment, where you have an investment that can go away if rates go down, and then you're forced to reinvest in a lower rate environment. Same thing with CMOs and MBS. You want to make sure you understand and you're protected. And you can do that through the CMO structuring. So the other thing to understand is cash flow or extension risk. If rates continue to rise, now we do expect rates are going to go up a little bit more. We'll talk about it once again a week from now. We got our economic update. But extension risk, if rates continue to go up and all the homeowners, they have their incentive to prepay their loans go away. One, property values are continue to go up. They got a really cheap financing rate on their mortgage. Why would they want to pay it off? So if you got to understand what is the extension risk of the security, and is the characteristics of the security you're buying insulating you from that risk, or at least minimizing that risk. And then we already talked about loan portfolio and loan steps, what type of borrowers are in there and what type of loans are there. Very important to understand as we go through and analyze that. All right, and then second to last topic is what I want to talk about is CMBS, and that stands for commercial mortgage-backed securities. The prior ones, CMOs and MBS, are residential. So most common type of commercial mortgage-backed securities are your Fannie Mae DUS, Freddie K's, and Fresbees. There's a lot of other ones, but these are your most common ones for 201 right now. Have people gotten in trouble with CMBS? Absolutely. Once again, have they gotten in trouble with any other asset class? Absolutely. We've seen people get in trouble with just a CD portfolio, quite frankly, for investing over, not looking at financials, going over insurance limits. I don't want to digress too much. People on the call that know me, I know I can digress a lot. It could be 3 hours of talking here. So anyway, Fannie Mae DUS just is a great bullet alternative. What I mean by that is they're structured just like a commercial loan. So there's typically one loan in this security, and there are risks there. I'll talk about those risks. It's usually a multifamily housing project that has a balloon date on it with a longer amortization, going down to that commercial loan terminology. And it has an IO period as well. So understanding what the cash flows is extremely important. They're a fixed rate, and there can be a lot of risk involved in these. Depends on what kind of prepayment risks are built into that underlying loan, and looking at that loan and understanding that. And this gets down to, once again, similar to residential, is you have the ability to look at the loan that backs this bond. What is the occupancy rate? What is the loan to value? How old is the project? You can see what the propensity is, or the ability for that borrower to be repaying or paying off or selling. And if you're paying a premium for this, and there's not a lot of prepayment protection through yield maintenance, for example, as a one term, or just outright 3-2-1s or 5-3-2-1 prepayment penalties, it might be hard to model, and you do have a premium at risk. So for any of these structures, depending on where interest rates are, and is it on a secondary market of when it was issued, it could be okay without risk on the secondary market, especially in a rising rate environment. But in normal times, we really like to focus in on a new issue for any of these structures. And the reason being is all of a sudden we're investing into prepayment penalties. Whether it's a prepayment or whether it's yield maintenance, you're getting it right from the start. It's a little easier to model and understand. At least you're, for a relatively a predictable period of time, can model what your risks are. Now, Freddie K's have multiple loans in there, a little bit larger than Fresbee's, but they're structured like a CMO. There's going to be certain tranches. You can have a variable rate tranche. You can have a 3-year, a 5-year, a 7-year balloon types tranches, can be fixed or floating. A lot of different structures, but commercial loans that are backed in. And when I say multiple, it's not like thousands and thousands. We're talking anywhere from 20 up to 100, but it does give you that diversity. Remember, we talked a lot about diversity today. that can back that. And then FRESBs are even smaller loans, typically have more loans than Freddie K, but similar to structuring, have different types of fixed and floatings or fixed to float hybrid. It's backed by smaller loans as well. Some of the CMBS, depending on those loans, as you can manage, and just like residential, can be CRA eligible, especially if it's even if it's a Fannie Mae DUS 1 loan, or if it's a Freddie K or FRESB, there may be some loans that are in there that are serving an area that are low to moderate. And what would happen is especially, and we like to do it on the new issue, is look at all the loans within there, look at our clients and say, this is right in our footprint. Let's go work with the issuer, get a letter and say that loan is what we're necessary. We want that as credit for investing into this pool. And they'll actually issue a letter saying this institution is investing this money into this loan. And even though it's wrapped into a bigger product there. Once again, Fannie, Freddie, agency wrapped, so 20% risk weighting there. I'm not going to talk a lot about mutual funds. They're out there, especially in a low rate environment. People were getting sold these, drinking the Kool-Aid, is like I used to say, is they can be backed by stocks and bonds. But most of you here would be just really looking at a bond mutual fund. There's a big marketing push for short bond funds or ultra short bond funds. All the different companies have them in a low rate environment because you get a little extra yield as an alternative to cash. Well, I don't know. I call that bunk, quite frankly, because it's not an alternative for cash, because you're buying something that trades on a share, the NAV, the NAV, and it goes up and down. And when rates rise, your NAV goes down, and that's actually a tradable security as a mutual fund, and it's not a fixed income cash alternative because you got to mark that to market. We don't mark the market on cash. So anyway, you're buying a slice of a pool of monies that are investing in certain types of fixed income securities that have no fixed maturity date. Whereas if you just buy the bonds and create a structured, deliberate portfolio of investments that match the rest of your balance sheet, then all of a sudden you are having a managed portfolio that you control, not a money market fund or not a mutual fund where you don't have control of that maturity. You don't have a great exit strategy unless you can build in some kind of understanding of, here's my risk and I'm willing to lose this much if rates go up. Now, it doesn't seem like a great strategy to me. Use fixed income securities. All right. We're not a 401k. We're not a retirement fund. We're an investment portfolio of a financial institution. All right. So just some pros and cons. I didn't want to spend a lot of time, so I got to get into some duration here. NAV, dividend distributions, there are some pros to them. Capital gains distributions, dividend distributions. Dividends don't have to be in there. There's fees that are built in there. You got some mark to market that takes place in there. And then lastly, your risk is, what is an exit strategy? And you can't necessarily create one that's reliable at the very onset of the investment. So it doesn't necessarily make sense for the balance sheets. Now, diversity, we talked about all these asset classes. Really going down to the fundamentals of portfolio management for you guys is duration. And we get asked this question all the time. Hey, what's the ideal duration of an investment portfolio for a bank or credit union? And the answer is, it depends. And that's the right thing. The duration of a portfolio should be complementary to the rest of your balance sheet, and understanding the duration of your loans, your risk of the movement of that duration, your duration of your liabilities, tying that together, and where does your portfolio complement the rest of your balance sheet? And in reality, if you think about it, you can only really control 100%, or at least reasonably close, what the duration is of this asset on your balance sheet, your investments, because you're making the decision to buy something or sell something. Lending, you're creating your loan products that hopefully consumers are buying or businesses are borrowing with, but the borrowers have the control, even though you have the product, meaning they can pay off their loans early, they'll be delinquent, we could do a lot of things, but that will change durations. Investments, you control whether you want a short-term, long-term, a cash, and it's really important to understand what the rest of your balance sheet is so you can really do the right thing with your investments. Duration, it takes into a lot of things: the maturity date, your yield, what the coupon is, and then what is the optionality of that investment, the call features or amortization of it. So simply put, your duration is truly a measurement of the price sensitivity of your portfolio or price sensitivity of individual securities. So why is this important? It's so you can manage your risk. Now, managing your financial institution risk involves a lot of different things. Today, we're just talking about investments. And so we got credit risk. We talked about that, but here is what we got is interest rate risk. And so making sure you have the ability to go in, look at that average life, look at the duration. What is the risk to that duration changing based on the characteristics of the security is ultra important, or else you won't be able to manage your portfolio correctly. So what does the balance sheet look like? Once again, looking at what your loans are. Do we have variable rate loans on our books? Do we have all commercial loans on our books that have, typical five-year balloon with a 15-year amortization or some structure like that? Do we have a portfolio of residential loans or a portfolio of auto loans that are shorter duration? Really analyzing and slicing your loan portfolio is the first step to understanding what is our base duration of our risk and our highest earning asset class. Then look at what your liability structure is. How does that complement your loan structure? And then what would a portfolio structure do to increase or decrease the duration of our entire balance sheet? Because once again, this goes down to a thought of ALM. We don't necessarily eliminate risk. We want to manage that risk, understand that risk, and the investment portfolio allows you to do that. So, and once we identify what duration really works well with the rest of our balance sheet, then we kind of look at what's the strategy to get there. Do we use a maturity ladder? Very distinct ladder of securities that have an overall duration, and what is the price sensitivity of that? And should we, which the answer is yes, minimize the negative convexity of these bonds so we can we can really reasonably rely upon our analysis. A couple of ideas on how to look at that ladder. The lower left hand here is a deliberate ladder. It has a nice bell-shaped curve. It's mid-year, so the first year is 2022, halfway through, and then you got 23, 4, 5, 6, and so forth, and you got a good deliberate set of cash flows you can rely upon. And if you look at that green versus the tan bar there, they're not too different, but what they do represent is what would our cash flows look like if rates went down 100 basis points, that's the green bar, or rates went up 100 basis points, that's the gray bar. They didn't change too far off the dotted line. So once again, minimizing optionality or negative convexity in the portfolio. And then the right-hand side is a different strategy. It's not wrong, it's just different. And it's called like a barbell. A little heavier, there's not a component here, but of cash, heavy on the short end, ignoring the belly, and investing heavier in the long end. But ultimately, you're still creating a duration that really matches the rest of your balance sheet. And depending on the interest rate curve and the environment, one may make sense over the other, but more often than not, that really deliberate bell-shaped curve works a little bit more to your favor over time. It's a little bit easier to follow through. All right, some examples about duration, and we got about 6 minutes left, so I'll continue on, and I'm almost done. Is what does duration mean in price sensitivity? So there's average life and there's price sensitivity. Duration is price sensitivity. And in simplest, very high level terms, a 1 year duration or a one duration means if rates go up 100 basis points, your value of your investments go down 100 basis or 1%. For a 5 duration, goes down 5% if rates go up 100 basis points, and so forth. With 10 is 10. And then opposite is if rates drop, your appreciation goes up similar as well. So that's kind of a measurement and what it really means from a price sensitivity standpoint. Now, when you get some bonds that have a lot of optionality into it, you're going to see some of these price changes change a little bit because there can be a deliberate shift in your market value changes with bonds that have a lot of convexity to them. All right, so little example to make sure you're understanding when looking at some of these asset classes for diversification and talking about negative convexity. And basically with negative convexity is your duration or your price sensitivity increases as rates increase. So there's that extension risk. Your duration increases. And that's very representative in mortgage-backed securities, not really well-structured CMOs. Callable bonds is another example. And then lower coupon bonds as well as another one that has negative convexity. And that's really strange. You can have a bond with a fixed maturity and a fixed coupon, but yet the lower coupon bond with versus a high coupon bond with the same maturity date will have a different convexity. And the reason being is the higher coupon bond has a shorter duration. And the reason being is you're getting more cash flows back quicker with a higher coupon. So in positive convexity is where duration decreases as rates increase. And that's kind of comes with floating rate bonds and higher coupon bonds as well. So just a little high level on convexity there. So summing it up is how do we best manage all of these components, right? And it always comes down to diversification amongst asset classes. That limits your risk in any one given sector, not only from an interest rate or a value standpoint, but also from a credit standpoint. Secondly is term. Making sure you've got a solid understanding of the cash flows that your investment portfolio is going to provide for you and choosing securities that will be reliable, right? Be reliable regardless of what happens to the economic environment, regardless of what the Fed does, if they raise rates or declines rates. And then lastly is risk. Understanding the entire balance sheet risk and what happens to the duration of my lending portfolio, my liabilities, in addition to my loan investment portfolio. So we are managing the entire balance sheet. So once again, we're going to do okay whether rates continue to rise a little bit. I'm not going to say a lot of it because they're not going to raise a lot of it, or start to go back down, which they will in the future. So that holistic balance sheet is extremely important, not just be a portfolio manager for the investments. So let me go up. I've been talking for a little bit. We've got a time of about 2:58. I want to do a little cleanup here, an announcement. Our next webinar is going to be a week out from today, 7 days out, 2 o'clock Eastern Standard Time next Wednesday. It will be our mid-year economic update. We're going to talk a lot more about the economy, what's happening, what we're seeing, and what we're expecting in the future. And we do have a lot of mixed opinions that we're hearing and seeing, and you guys all know that. The big word recession comes out, the word stagflation comes out, overheated economy, behind the ball of raising interest rates are just right, because you saw that the difference between what the market expects and what the governors expect. So it's going to be a great economic update a week out there. All of our emails, you can register. If you're not a customer and you want to, reach out to Kaylee. Her email is there, kstarkey@m-f-a.com. Would love to have you. Love to have others of your organization as well. Please share those words there. And then I want to just ask, is there any questions out there that I can answer? Please feel free to put it in the Q&A or in the chat. Okay. Okay, I'm not seeing any out there at the moment, so I just want to thank everybody from across the country for participating. We appreciate the relationships with everybody, and I hope everybody has a great day. Oh, wait, there's one question that came up and said, oh, thank you. You're welcome, and thank you for the kind comments. I hope everybody has a wonderful afternoon. Take care.